Now, on this InvestTalk podcast, Justin Klein listens to your questions and provides unbiased answers.
The chart is definitely in a downtrend, and it's definitely not cheap enough yet.
InvestTalk. Your participation makes it unique. 888-99-CHART.
At a time when investors are confronted with market volatility and a variety of challenges fueled by the uncertainty of inflation, unsettled geopolitical tensions, and economic pressures, Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. This is InvestTalk, independent thinking, shared success. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Chief Executive Officer, Financial Advisor, Justin Klein.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Tuesday, August 2nd, 2022 edition. Now, as investors in our interest to pay close attention to the U.S. economy and the labor force, it's very important to pay attention to the unemployment rate as an important piece of the puzzle. So let's first start off with the definition of employment rate is the percentage of unemployed workers in the labor force. Remember, that's the labor force, not total population, the people that are either working or actively looking for work. That is the labor force. Now, this ebbs and flows with the economy, and you probably wondered how many people are unemployed in the U.S. And from the United States Bureau of Labor Statistics, and the current numbers as of June, the current unemployment rate sits at 3.6%. Total of unemployed people 5.9 million, and unemployed insurance claims 1.7 million. So not everybody that is unemployed is collecting unemployment. They may be unemployed for a long period of time, and that might have run out. Now, to broaden the perspective, let's look at unemployment figures for the past 90 years. And the highest rate of U.S. unemployment was 24.9% in 1933 during the Great Depression, obviously, and unemployment remained above 14% from 1931 to 1940. That entire decade that's what they called the Great Depression, just very, very worse than the 08 financial crisis, which peaked out right around, let's see. Oh, that's interesting. From 1940 to 1982, unemployment rate stayed at single digits until September 1982. That's when it reached 10.1%. During the Great Recession, also reached about 10% in October of that year. Now, in 2020, the unemployment rate did get to double digits, 14.7 for a brief period of time, but obviously came back down pretty quickly. The lowest unemployment rate in modern history, 1.2%, 1944, after the Great New Deal, getting everyone to work on building roads and bridges and Hoover Dam, etc. So that was some historical context to what we're seeing today and what the numbers look like in relation to history. Now, I'm Justin Klein, and I look forward to this hour with you, giving some more information, some more perspective to help answer your finance and investment questions with my straight and unbiased answers. Now, most importantly today is to help you take that next step in your own version of financial freedom. And this is a different investment environment, and that means you have to have your head in a swivel both ways. It's not just about low inflation that would dip into deflation. No, this is higher inflationary environment that's going to ebb and flow in a bigger way. And so that means more volatility, more opportunity, but more risks as well. So our goal is to help you take advantage of those risks and avoid the pitfalls that come with a volatile market. So I invite your phone calls and questions right now during our Anytime Listener on our Anytime Listener line, which is 888-99-CHART, or if you're listening live, 4 to 5 Pacific time, you can call and ask your question directly. So let's get right to our first listener question now.
Hi, Steve and Justin. This is Nick calling from Idaho. I have a question about I-bonds. Right now, the interest rate is 9.6%, and the interest rate changes on November 1st. I'm wondering if you guys think that the interest rate will increase or decrease based on the more recent CPIs, and whether I should buy a full $10,000 worth now or maybe buy half now and then half in November at the new rate. Thanks. Bye.
Well, it shouldn't matter unless you think that the rate is going to go up. And I think the rate's going to go down. Now, is it going to go down a ton? Probably not, but it's likely to go down in November to some degree. So I would be buying now if you're going to try to allot your $10,000 for the year. Is it going to be now or wait till November? I would say do it now, especially since you have a year until you can touch that money, or it's locked up for a year. And then you're going to have exposed to another potential decline 6 months after November. And so I would rather be buying now because I do think it will dip. And you look at the manufactured prices paid index that came out yesterday on the ISM figure, that came down pretty dramatically. And so that's a leading indicator typically of where inflation is going. And inflation is likely headed lower for the end of, between now and the end of the year. It's just a matter of the magnitude. All right. Thanks for the call. Now, my focus point today is based on this headline: the big risk with employee stock purchase plans, ESPPs. A 2020 report has revealed that those who participated in both a 401k and an ESPP contributed 32% more to their 401k than employees who just invested in the 401k itself. Now, if we have time, here are some other topics that I will touch base on as well. One is manufacturing activity. I want to go over the ISM report yesterday and give you a rundown of how recessionary it looks. Also, the inherited IRA. The IRS is changing some rules, so I wanted to give you an update there. And then lastly, what low-cost areas are going to be able to fight the headwind of higher mortgage rates and could avoid a price decline? So we're going to look at that as well. But ultimately, I want to know what is on your mind, so give me a call. 888-99-CHART is how you get through and ask your question on today's show. Now, let's take a look at the market. The S&P was down 27 points. We rallied into the 100-day moving average, which would naturally be resistance. So to have a little bit of down day today is not a shock. You definitely had growth outperforming value, which was interesting considering the 10-year was up pretty dramatically today, up 13.5 basis points. So that was a pretty big move off of some decent support on the 10-year. And I've said this before that I think we're now entering a trading range on the 10-year, probably between 2.5 and maybe 3.25, just to see what the next move of the economy will be, of what inflation will be, what the Fed will be doing, not just the next few months, because that's kind of known. What gets more murkier is what happens after the, is it the September? And I believe it's the next two meetings, basically. That's kind of known, 50 and probably 25 basis points. But what happens after that? Are they going to, is their next move another hike? Is it a pause for a while? Is it a quick cut at some point early next year? I think that's what the market is going to try to battle with, especially as you have an inverted yield curve, in some parts, a flat yield curve, and others. Just shows that the slowdown in the economy that the bond market is expecting. So we're entering likely this trading range on the on interest rates. The dollar, that was up strongly as well on the back of those higher rates. You had gold that was down just a bit on the higher rates, and then you had small caps that was about flat on the day. So they definitely had some leadership there in small caps and the growth side of the market. Now we're heading into a break, and I welcome your finance and investment questions now. So give me a call on InvestTalk at 888-99-CHART.
Why do listener questions make InvestTalk better?
Which of these would you recommend?
Because each caller presents fresh questions in their voice.
I was curious if you still think aluminum has a ways to go from here.
When do I know the right time to take profits?
Should I be looking for an exit? Should I be holding here?
And listeners instinctively realize that InvestTalk uniquely offers a welcome dose of investing satisfaction.
I think you have a terrific show, and I've learned a whole lot.
Hey guys, love your show. I've been listening for several years now, and I've learned a lot.
Justin Klein and Steve Peasley understand what investors need and want.
I would look at it from a tax perspective. If there's no tax implications, move on, find better ways to use that money.
I'm going with the odds. I think a half position now would at least get you in it and get you watching it so you won't lose track of it.
Don't forget to call InvestTalk. 888-99-CHART. Each day, InvestTalk listeners submit their finance and investment questions via phone or email. Would you like your question to be put near the top of the list? Just take a minute or two to leave a review and rating for InvestTalk at iTunes. And be sure to include a brief question with your iTunes review comments.
Let's head over to Arkansas. We're going to talk with Alan. He wants to talk about buying bonds.
Yeah. So Steve always says it's best to buy the physical bond. And I called my broker today, Fidelity, and I wanted to get a tip, the interest one. And I wondered if I could get the physical bond, and they said, no, you can't. So I'm just wondering, do I have to go to a different broker to get the physical bond?
That's interesting. Now, you could probably buy it through treasurydirect.gov. You can buy not just that's the place where a lot of people buy I-bonds, but you can buy other types of bonds, savings bonds, and you might be able to buy tips through there as well. Let me see. Yeah, I believe you can. I would rather buy I-bonds over tips. So if you're staying under the $10,000 rule, then I would probably go with the I-bonds over directly tips. Does that make sense?
Okay, yeah.
Okay. Yeah, so head over to treasurydirect.gov. Let's go to Florida, and we're going to talk to Chris, who wants to talk about Uber.
Hey, Justin. I just had a question about Uber in regards to earnings results. How stock surged on those. They lost money, and it was just on sales growth. And also Kathy Wood's comments last week on CNBC about how growth is still going to lead the way. Just curious on your thoughts.
I mean, just Kathy Wood, there's really no comment need to be made there. She's a big destroyer of capital. If you look at the flows of assets into her funds, and she's already shut down one, and she'll shut down many others. This happens in every market cycle. She jumped on a fad and made big returns in a short period of time, and everyone chased those returns. But the old saying is, you can chase returns, but you'll never catch them. And that's what's happening in the ARK funds. And so I don't really need to comment too much on Kathy because she's been wrong outside of, a very short period of time consistently. So, and then when it comes to Uber, this is a good example of a company that it was down and on expectations of the bad earnings report, and they came out with one, and it wasn't quite as bad as expected, but still they lost $1.32 per share after losing $3.04 last year. Last quarter. And so this year they're expected to lose $3.59, and that's better than 2019 when they lost $5.04. But their business prospects continue to be rough. And ultimately, I don't think Uber is a great long-term investment. They've clearly been a destroyer of capital. And they're, do you really care whether you're driven by an Uber or a Lyft or, another competitor? Probably not. It's like airlines back in the day when you just want to get from point A to point B, and Uber is the same way. Now, I think it's going to stay around, and there'll be enough people to throw more shares at it, etc. But certainly isn't going to be a good long-term investment. So I would pass on Uber. Now, I think it's time for a break, and then when I return, I will take a tackle at my focus point. So give me a call at 888-99-CHART.
Each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. You, the caller, get to chart the course for each InvestTalk podcast. Call with your questions anytime, day or night, 888-99-CHART.
Now, my focus point today is based on this headline: the big risk with employee stock purchase plans. Now, these are pretty popular. Nearly 3/4 of public companies offer an ESPP, an employee stock purchase plan, as of 2018. And typically how this works is that participants are given some sort of a discount to the share price. And ideally, in the best case scenario, there's called a look back period. Look at the low and the high, and whatever is most advantageous over the previous quarter is used for the price, and then they take the 15% or whatever the discount is on those shares. Now, those who participated in 401ks and ESPPs contribute 32% more than those that just contribute to their 401k. And there are pros and cons to this. Now, the first is ESPPs are capped at $25,000 per year for tax-qualified plans, so there are some limitations to it. But nearly 4 in 10 public companies offer discounts and a look-back period, which is nice. Now, there are complicated tax rules to consider. There are levies on the discount. There's also a breakdown whether this is considered regular income or long-term capital gains. That depends on when you sell the shares. And some companies have holding periods. They don't want you to flip the shares and sell them immediately. So you want to know whether the ESPP is tax qualified, and the length of offering period, the purchase dates, how to make changes, what happens if you pull out of the plan, etc. All these are factors you have to consider if you are eligible for an ESPP. Now, another thing to consider is there's no guarantee that you will make a profit. Just because you're getting a 15% discount does not mean that the stock's always going to go up. They don't. From 1980 to 2020, 45% of companies from the Russell 3000 index suffered a 70% price decline from the peak and never recovered. 45%, nearly half of the stocks over that period. So once again, this is not something that is a guaranteed win. It is a calculated bet. 15% is nice. It gives you a better chance. But if you're getting 15% of a company, 15% discount on a company that is drastically overvalued or has a questionable business model that doesn't have long-term sustainable profit and cash flows, you may be getting a discount on something that is drastically overvalued. And over time, that is detrimental to your financial health. And then on top of that, you're working at that company as well, and there could be a risk of layoff longer term. So you certainly have to understand, most particularly, the risk of the company that you are buying into. And how cyclical is the business? How much debt do they have? All of these factors are important to understand the overall risk you're taking. And then you don't want to have a large percentage of your net worth in one particular company. Just look at what happened with Enron. People just kept piling money into the ESPP with Enron and had 60, 70, 80, 90% of their retirement assets in Enron stock, and then we all know what happened. So you want to weigh your risk tolerance and your goals before you enter, and you want to make sure you're meeting your other financial goals first, maxing out your traditional 401k, which is much more well diversified, investing in your own brokerage account, other IRAs, Roth IRAs, paying off debts, hitting other savings goals as well. So as with anything, there are always pros and cons. And if that's something that the number one thing you should leave this show with each and every day is that every financial decision should come with weighing the upside and the downside, the risks and the reward. And everything has that. And if you're unaware of the risks, then you're probably going into something somewhat blind. And when you are blinded to the risks, you are often blindsided at some point with something you didn't expect because you didn't have your eye on it. So ESPPs are example of that. Now let's squeeze in another caller question before the break. This one came in earlier from Wisconsin.
Hi, this is Jackie from Wisconsin, and I'm calling about I as in igloo, YH. I just wanted to hear your opinion on this ETF and if it was a good buy point right now. I'll listen to your answer on the podcast. Thanks. Bye.
All right. This is the iShares U.S. Healthcare ETF, one of the largest healthcare ETFs in the world with about $3 billion in assets. And historically, healthcare stocks are pretty consistent companies. The issue, though, is they tend to not do that well in an inflationary environment. And the top holding is United Health, and that's currently a bit overvalued. There's risk of changes with universal healthcare or single-payer healthcare type of changes long term. Your second biggest holding, 9% of the portfolio, Johnson & Johnson. That's pretty well diversified. They also have a COVID vaccine that has some issues with it. Same with Pfizer, which is 5.5% of it, and the mRNA platform is looking less secure over time. So you certainly have risks there, and it's not particularly undervalued. So I'm not a big fan of it. I don't love the exposure to biotechs and the healthcare space in general right now. You have to be very selective, and I don't like this broad exposure. Now we're heading into a break, so I'm taking your questions live at 888-99-CHART. Get ready to hear a cha-ching that can make your life a whole lot easier. That's the sound of another smooth Shopify transaction. And now you ask, what is Shopify?
Quite simply, Shopify is the all-in-one commerce platform that you can use to start, run, and grow your business. Shopify is designed for anyone to sell anywhere, giving entrepreneurs the resources once exclusively reserved for big business. You can customize Shopify for your particular business needs.
Shopify provides a great-looking online store that brings your ideas to life with easy access to the tools to manage your day-to-day operations and drive sales. Know this, Shopify powers millions of entrepreneurs from first sale to full scale. That's more than a catchy phrase. It's reality. With Shopify, you can get started by building and customizing your online store without the need for coding or design experience. Shopify has thousands of integrations and third-party apps, from on-demand printing to accounting to advanced chatbots and beyond. Shopify instantly lets you accept all major payment methods. Plus, with 24/7 support, you're never alone.
More than a store, Shopify grows with you. Are you ready to take your dream to the next level? Go to shopify.com/invest, all lowercase, and get full access to Shopify's entire suite of features. Start selling on Shopify today. Go to shopify.com/invest right now. Shopify.com/invest.
VEIRX is men's activewear that's built to be comfortable, functional, and stylish. Their versatile clothing is made from fabrics that flex and fit perfectly for any activity, whether it's at the gym or on the go. VEIRX is fit for living, and these wardrobe staples are sure to be your favorite things to wear. VEIRX is available at Dick's Sporting Goods, or get 15% off regular price items when you go to VRST.com and use the promo code podcast15, all in caps. That's podcast15, all capital letters.
InvestTalk is always made better when our listeners contribute their questions. So tell your friends and family members they can interact in real time with Steve Peasley and Justin Klein during the InvestTalk live stream program between 4 and 5 p.m. Pacific Time. Or they can leave their questions anytime, 24/7 in the InvestTalk voice bank. 888-99-CHART.
On the next InvestTalk, the story behind this headline: avoid this disruptor in decline. Disruptor stocks go through 4 distinct phases, but 2 of those can be very dangerous. That story tomorrow. But let's dig into the trends within the ISM report yesterday, and it was pretty illuminating when you look a little deeper. Now, on the surface, the ISM manufacturing index came in at 52.8% in the month of July. That's slightly down from the 53 in June. Remember, anything above 50 is growth. So while growth is slowing, there is still growth in the manufacturing sector. Now, the sub-indices within the report showed more of a mixed bag. You had the prices paid index that came down from 78.5 to 60, which brings it to the lowest level in nearly 2 years, and I think the biggest decline since the financial crisis. And so that was a positive overall if you're thinking that you want to see inflation to come down and the Fed to maybe pull off the brake pedal when it comes to raising interest rates. And then in employment index, that was a little bit below 50, so you saw a little bit of contraction there. New orders came in at 48. That was also in contraction. The employment index was interesting. It was 49.9, so slight contraction, but that was up from 47.3 in the previous month. And you had construction spending. That was a separate report. That was down 1.1%. And overall, what you're seeing is that while everyone's talking about recession, you're still seeing growth in the manufacturing side. And I think a lot of that has to do with pent-up demand, not necessarily for cheap goods, but more high-quality goods, because that's what we produce here in the U.S. We don't produce a lot of the stuff that is oversupplied in the market. Most of that stuff right now is made in China. And if you look at the ISM report over history, below 48.7, that is an indication that we're in a recession, and we're not quite there yet. So yes, we're in a technical recession. That's true. But, are we seeing recessionary type conditions in the business community? Not quite yet. More of stalling out, kind of very, very slow growth. And consumer demand continues to fall, but the demand for things like cars, which we make a lot of those here in the U.S., continues to be relatively robust. So overall, pretty decent report out of the manufacturing index yesterday. Still modest growth with fast decelerating inflationary pressures. A lot of that had to do commodities prices coming down, and that obviously feeds into those prices of manufacturing goods. Now, it's not every day that we get calls from Arkansas, and we had a live call at the top of the podcast, and now we have a recorded question from a different listener, and it came in earlier also from Arkansas on 888-99-CHART.
Hi, this is Paul calling from Arkansas. I'm looking to add some income funds to my portfolio. One I'm looking at is a PIMCO fund, PMF, P as in Paul, M as in Mary, F as in Frank. It looks like a federal income tax exempt fund. I'm curious as what the risks might be besides, obviously interest rates going up could put the fund down, as well as any of the holdings, Municipal going bankrupt, I guess. But I was wondering if there's anything else I should consider before deciding to add this to my portfolio. I appreciate it. Thank you very much. Bye-bye.
All right, this is the PIMCO Municipal Income Fund. PMF is the symbol. Morningstar is giving it 3 out of 5 stars, so about an average fund. And it is relatively short-term in duration. 55% of the holdings are between 4 and 6 years. Oh, no, sorry, that's coupon range. Let me go to maturity schedule. Excuse me. Never mind. Let me take that all the way back. 44% of the holdings here are between 20 and 30 years in duration. 11%, 15 and 20, 13%, 10 to 15. So you're talking about, let's see, 30, 60, that's 70% of the portfolio here. Actually, even go 15% is over 30 years. So only, I would say 85 to 90% of this portfolio is very, very long term. And that's why you get a lot of duration risk. And that's why you've seen this fund drop from 15 to a low of about $10. So down 33% over the span of the last 6 months. Now it has had a little bit of a rebound to $11.75, but you're taking a lot of duration risk. And that's my worry here. Now, the municipal side, I don't worry too much about the credit quality as long as they're U.S. based, and because I think the government's going to go and kind of bail out any major municipal issues. So you're well diversified here. I don't think that's the issue, but you are taking a ton of duration risk, which I'm not a fan of. It does have a lot of leverage as well, 47% leverage. So you're getting a leverage on top of that. So you're getting nice distribution, but you're getting the leverage. And that's why, you have long duration, you have a lot of leverage. Hey, that's a ton of risk on that side. And that's why I probably wouldn't recommend this because of that leverage and that long duration. I would keep it something unlevered and relatively shorter term. And, you live in Arkansas, so you probably want to get something that helps you avoid the Arkansas tax rate, state tax rate. Typically, these federally tax-free funds are better for those that live in tax-free states. You live in Texas and Florida, etc. You don't care about state tax exemption because you don't have any state tax. So you just are focused on federally tax-free. And then on top of that, make sure these really only make sense for people in the very top tax bracket because the yields are so relatively low. So that's how you want to look at municipals. And this fund, not a fan overall, kind of average and long duration, which I'm not a fan of. Now let's play two in a row. The next question from Illinois.
Hi, Steve or Justin. This is Ray from Illinois. Very much appreciate the podcast and everything you teach your listeners. I have a question about fractional shares. A lot of the online brokers are advertising fractional shares. And I was wondering, from your standpoint, is there a downside in buying fractional shares versus whole shares? Just thinking in terms of investing in round dollar amounts as opposed to specific number of shares when buying and selling stocks. If you could let me know, I would appreciate it. Thank you.
Not really. We used to buy round lots for our clients, but it doesn't make sense anymore. Now that the rate is so low, the commission rate's so low, that used to be the biggest drawback, right? You don't want to buy 2 shares of something or 2.5 shares when you're paying a $7 commission. Well, now you don't have to pay that. So it's not really a worry. So fractional shares, non-fractional shares, I think it's more of a gimmick than anything else. It's nice for younger people or people that don't have a lot of money to be able to go buy companies that have a high stock price. Google was one of those until the recent share split. Amazon, same thing. So there are companies that do get up there in nominal price, and a lot of people can't afford just one share. So fractional is nice if you can do it. And a lot of platforms are allowing that now. Robinhood and that is spread to Fidelity, Schwab, TD, etc. So nothing wrong with fractional shares. It's always about the overall percentage of your portfolio. And now that there's no commissions, not a big deal. Now let's pivot over to the inherited IRA rules. And this is a recent change because of the 2019 Secure Act, and it introduced a new 10-year payout rule for inherited accounts. Now the previous rule before this said that those who had got an inherited IRA, Roth IRA, 401k, they could spread out the withdrawals over their lifetime. So it was a low amount RMD that they had to take out, added to their adjusted gross income, and it typically wasn't a big tax burden because of that. But this new 10-year rule was designed to get more cash into government coffers faster. And most tax professionals looked at this rule and they thought, well, they just need to take the money out by the end of the 10th year. And that was until in May of last year, there was a revision by the IRS where they stated that they had new guidance that would require heirs to take annual withdrawals in cases where the original owner died on or after his required beginning date for taking distribution, so his RMD date. So if the owner died after their RMD date, then that means you can't just wait until the end of the 10 years and then take it all out. You have to kind of act like that person was still alive. You have to take out money each year over those 10 years. And this also applies to 401ks as well. Now, payouts from traditional inherited IRAs are taxed like income. And that means people are taxed at a higher rate on that because they're usually when they're working, as opposed to they could wait their entire life, and a lot of that distribution would come in their latter years when they are retired. Now, taxpayers can deal with this new guidance in a few ways. They can calculate the necessary amounts out each year. I did that for a client the other day. And taxpayers who fail to take that RMD will be hit with a penalty of half the total amount they should be taken out. Now, spouses and certain heirs like disabled individuals, they can spread it out over their lifetimes. But if it's a child or a grandchild, well, that triggers the 10-year rule. And inherited IRAs, owners don't have to take the payout until the end of the 10 years on Roth. Remember, Roths have already paid the payout or the tax, so you never have to pay taxes on that again. Now, some taxpayers and tax groups are urging the IRS to change this and update the guidance, but it's still relatively unclear what they're going to do. They could make taxpayers make up missed distributions, or they could go back to the previous guidance as they did before. So we're still waiting on what happens, and they'll probably come up with updated guidance by the end of the year. And you might want to be patient on that until you hear about that, if you have an inherited IRA. Now let's go to Ken in San Diego. Wants to talk about VEIRX. You own it or looking to buy it?
I own the stock. I've had it several years. Matter of fact, we talked about this on the podcast once before. Anyway, I've been using it to feed my RMD system, and I was wondering if I could get your thoughts on that now.
Okay. Yeah, this is the Vanguard Equity Income Mutual Fund. So it's a well diversified. About 90% it is in equities, so it is relatively aggressive, but it's certainly leaning on the value side of the market because it is interested most on income. And only about 9.4% in technology, so that's relatively low. That's pretty good. Healthcare is 20%, so that'd be my biggest worry there. Only 0.5% of real estate. I would like that to be higher. But energy, 8.3%. That's more than double the overall S&P exposure. Industrials, 9.3%. Pretty good, but would like that to be higher as well. So, but overall, the mix is pretty solid on that side, and about 7.5% in non-U.S. equities, so foreign stocks. That's relatively low, but a decent exposure. So this gets 5 stars on Morningstar. The yield, or say the expense ratio, is pretty low at 0.19% annually. And so I have no problem with it. Just understand this is all equity, so it's certainly going to be volatile. But if you're okay with that, you're okay with the potential volatility of equities, this is a pretty solid name.
Yes, I understand about the volatility. But anyway, I think I'll stay with it. Thanks a lot for the information. I enjoy your program very much.
Appreciate it, Ken. Good luck with all that. Now we're we're in the middle of the hottest summer days, and this is the time of year when market volatility generally heats up. And volatility means that you need to have your head on a swivel, like I said at the top of the show, and you have to update your strategies. And I think it's worth taking a minute to make you aware of some of the benefits of working with myself or Steve Peasley at our company KAPP Financial, which is in Irvine, California, just south of LA. Now, we practice parallel investing which means we invest right alongside our clients. So that's when we say independent thinking and shared success. That's how we do it in practice. We practice parallel investing. So if you need help understanding whether your portfolio is aligned with the current market environment and whether your strategy makes sense given the economic and geopolitical backdrop, I encourage you to reach out to myself or Steve at our company, KPP, through investtalk.com, or give us a call at 800-557-5461 to schedule a free portfolio review assessment via telephone or GoToMeeting. We speak for a short period of time just to give an overview of where you're at, what your goals are, see if your portfolio is aligned. And we'd love to help you in any way. And the sooner you contact us, the sooner we can help get your portfolio optimized. Now let's grab a quick voice bank question from 888-99-chart.
Hi, Justin or Steve. Wanted to get your opinion on ticker symbol J, Jacobs Engineering. They had earnings yesterday, I believe, and their stock dropped a little bit. I'm still up about 20%. I've owned them for a couple of years now. Just wanted to get your thoughts on the company. If you think I should buy more, hold, or sell a little bit. Thank you. Bye.
All right, Jacobs Engineering is a global provider of engineering, design, procurement, construction, and maintenance services. And so it's firmly in the industrial and heavy construction space. Long term, they have pretty consistent profitability growth, and it's not going to blow your socks off with growth, but it's going to be relatively consistent. And I like that. I like those consistent businesses. Good cash flow, not a whole lot of debt on its balance sheet. Enterprise value to EBITDA about 16.7, which is kind of average over the long term. So I'm fine with it. Yes, it's dipped a little bit on the earnings, but I think it's modestly undervalued and a very solid, consistent company. So thumbs up. Now this is InvestTalk, and we're heading into our final break. So if you are going to call, you need to do that right now at 888-99-chart.
Now Justin's here, ready with answers, and he's waiting for your calls. 888-99-chart.
Hi, Steve and Justin. This is Jesse from New Hampshire. I had a question on Schwab, the bank, ticker symbol SCHW. I just wanted to know your guys' thoughts where they're not mentioned as much as some of the other bigger banks out there. Thanks. Look forward to hearing, and take care. Bye.
Well, that's a very good reason why it's not talked about as a bank, because it's not a bank. It's a broker. And I know this very well because our broker that we use for our clients is TD Ameritrade, and Schwab bought them. And they're in the midst of a merger over the next year plus. But yeah, this is not a bank. It is a brokerage firm. Now they have banking type services, but the vast majority of their revenue is not from lending. That's what banks typically do. There's some lending activity, but it's a very small percentage of their profit. Now, the biggest risk with Schwab is going to be the rules around selling order flow. And the SEC is certainly looking into this and could constrict how much they make per trade and put some rules around this, because this is kind of this there's new rules to the road that really haven't been written, because this road just started to go down after Robinhood really paved the way with free commissions, zero commissions, and that was driven by selling order flow to big high-frequency trading institutions like Fortress. And Schwab and Fidelity and all the other firms kind of did the same thing to some degree and got their commissions down to zero as well. So how is that going to impact the industry and profitability is probably the biggest risk for Schwab. But we like the company, but it's not a bank; it's a broker. Let's head over. Let's go check on another voicemail question at 888-99-chart.
Yes, hi, Steve and Justin. My name is Sarafi. I'm calling from Ohio. I've been a listener for the past 6 months, and you guys have been instrumental in my quest to become financially literate. My question is about dollar cost averaging for a portfolio of individual stocks. I have already maxed out all my retirement accounts, consisting of mutual funds. In June, I opened a taxable account with $30K, and I've been adding $2K a month. I am somewhat okay with the fundamental analysis, so I now have 16 well-diversified, stable growth and value stocks that are not in any of my mutual funds. My plan is to hold 18 to 20 for long term. Almost all of my positions have appreciated, so when I put more, my average cost basis goes up. Would that be okay if I just keep on working in positions that have at least 25% safety margin based on discounted cash flow or target price? Not that I'm good at it, but are there simple technical indicators to guide me? Thank you very much, and I'll wait for your answer on the podcast.
Well, there are simple technical indicators, and that would be the moving averages. And are they pointing up or are they pointed down? And typically that's a good indication of the overall trend. So that's number one. And number two is you're looking at 15, 16 different names, and that's decent diversification. But the statistics say you probably need somewhere in the 20 to 25 position range to be well diversified. And so that's what I would do as you're adding more positions, $2,000 per month. Then I would start to try to maybe take that 2,000 and put it in one position until you get up to around 25, and then you can kind of manage around that number, get it up to maybe 40 at the top end. So between 25 and 40 is probably a good sweet spot of the number of positions that you want to have in a particular portfolio. And so as you build that, you should broaden that out a little bit more just to create that diversity. So I hope that helped, and I hope to give all you a little guidance there, because a lot of people are exact opposite of you. They have not 15 or 16 names, they have 60, 70, 80, 100 names. We've seen clients come aboard with hundreds of names, and it takes a while to whittle that down, but make sure that you're not overexposed to any one position by only having 15 or 16%. Or sorry, 15 to 16 positions. Thanks for the call. Well, I think that sums it up for today. I appreciate you all tuning in to the show. And this has been another episode of InvestTalk. And I appreciate you all. And we're approaching 44 million downloads. And you can find yours for free anytime at iTunes, Spotify, Google Play. And be sure to rate and review. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461.